Chat with Traders, episode 105.
This is your key to the minds of trading's elite performers, those who profit in relentless markets. Here on the Chat with Traders podcast, you'll hear about the skill sets and tactics that lead winning traders to win, so you can level up and become a better trader. Here's your host, Aaron Fifield.
Hey team, what's going on? I really hope you had an incredible Christmas day, ate yourself silly and had plenty of laughs. For this episode, being 105, I asked Brendan Poots onto the podcast. Brendan is the founder of a sports betting hedge fund, the Priomha Group. The main sports which Priomha bet on include football, as in soccer, cricket, golf, and also horse racing and tennis. Priomha set up shop in Melbourne, Australia in 2010 and more recently have expanded with a second location in Gibraltar, which is in Europe. Since inception, at the time of recording this, December 2016, Priomha's Cloney fund has returned a little over 220%. The fund has had no losing years. Worst losing month was minus 6.4%. Best month was plus 11.8%. And the fund makes positive returns 77.8% of months. From listening to our chat, you'll get great insight to how Brendan runs his operation, from getting investors to buy in, to controlling risk and minimizing the volatility of returns, and how the fund makes money trading sports games. Naturally, there are many crossovers to financial markets, which you'll pick up on. I had a great time speaking with Brendan, and I hope you'll enjoy listening. Now, just a small announcement before we get to the meat of this episode. So I've recently struck up a bit of a deal with hedge for Chat with Traders listeners. Now, I'm sure many are already aware of hedge, but if not, the simplest way of putting it is hedge is a journaling tool built specifically for traders. And I know I don't need to emphasize just how important journaling is, as it's something we discuss frequently on this podcast. But the cool thing with hedge is it takes your journaling entries and trades and shows you metrics for how you're performing and areas that you can improve on. Ultimately, hedge helps you to discover your edge. It's got a lot of awesome features. Visit edgewonk.com, that's E-D-G-E, edge, wonk, W-O-N-K, edgewonk.com, and enter traders during checkout to score $20 off any package. For full transparency, I do receive a small kickback for anyone who purchases using the coupon code TRADERS, but the price is not inflated in order for me to be compensated. Like I mentioned, it'll actually save you $20. And I'm done. I'm Aaron Fifield, your host. Please welcome my guest, Brendan Poots. Sounds like you've had a pretty hectic week.
Yeah, well, this is one of the big things we trade on is the English Premier League and the European football.
Okay.
And this week they've got 3 full rounds. So they had a full round on Saturday, Sunday. They had a full round on Wednesday, Thursday, and they've got a full round this Saturday, Sunday. So there's been 30 matches we've had to go through and do our work with, so it's been quite hectic. And then when you throw in the cricket, which is going on at the moment, that's our other big sport. Yeah, it's been a big week.
Okay, and Christmas is coming up, so what are you doing? Are you shutting down over Christmas?
No, that's historically our busiest time, because you could imagine the same happens with the football, for instance. You'll have games on Christmas Eve, then you'll have another round on just Boxing Day and the next day, and then you've got another round on New Year's Day. So you've got another 3 sets of games in the space of 10 days. And then you've got, whenever there's these public holidays, like Easter and Christmas, that happens to be when there's a lot of sport. So subsequently, I tend to take my family's in Perth, mum and dad and brother, so I'll probably head back there early in the new year when there's a little bit of a lull.
Yeah, and when you get these big games happening around public holidays, does that bring more opportunity to make more money during those times, or not so much?
Yes, no, absolutely. There's so much more money that's being traded that obviously one of the keys to our success so far has been making sure that our trade size per match is proportionate to the total volume that will be traded on the match. So you don't want to be putting a really big bet on a match where there's not a lot of liquidity, because effectively you're betting against yourself. Whereas when you have these really big matches, there's so much liquidity that it doesn't matter because basically if we have a big trade and it goes wrong, we need to be able to get out. So you want to be trading an amount which the market will tolerate and will let you get out if things go wrong. Which is why we don't do it. To give you an example, an English Premier League match, a typical English Premier League match will have somewhere between $10 and $20 million traded on the platforms that we use. Those same platforms in an AFL match will have 300,000. So if you have a $20,000 bet in an AFL match, you're effectively almost 10% of the pool, and then you can't get out. So the bigger match, so we tend to focus on the most liquid sports because A, we think we've got an edge there, and B, it allows us to stake accordingly.
Okay. So this might be a bit of a strange question. I mean, me personally, I've never put a bet on a sports game in my life. So forgive me if this is kind of a weird question to ask, but how does it work? Because I always was sort of under the impression that the bookmaker says, we've got this game, these are the payout odds for if this team wins or whatever the situation is, that's how much you make, otherwise you lose your bet. But you're like talking about this as though it's kind of like an active marketplace where, there's liquidity issues and that sort of thing. Like, how does that work? Are you betting on a different sort of, I don't know if exchange is the right word, but a different kind of platform than what retail people are playing on?
Yeah, well, there are a few different global exchanges. So they work in global sports betting exchanges, and they work exactly the same as your typical stock market exchange, which is buyers and sellers meet, and they facilitate that meeting. But the big difference, and this is what has allowed our business to grow and develop, is the advent of in-play sports betting. So whereas previously, and we're talking probably 15 to 20 years ago, sports betting used to be a binary outcome, and you're exactly right in the way you described it. You used to put a bet on, and then you'd have to wait till the end of the match for the result, and you'd either win or you lose. But with the advent of in-play betting, what happens now is that as soon as the match starts, you can still bet. And as a result of that, say, for instance, you've got a bet on a team that's, let's say it's $2 each of two teams. You'd never get that with the bookmakers because they have their commission in there. But say you've bet on a team at $2 and it's a binary outcome, so it's a win-lose match, so the draw's not in there like it is in football. So say it's a rugby league or an AFL match, and your side goes to 20 points in front, say, so then the odds will have changed. So the side that's now 20 points in front, their $2 will now be $1.40, and the side that's now 20 points behind will have gone from $2 to $3.40 or something like that. So the market started at $2. Now the market's at $1.40, $3.40 or something like that. So what you can do, you can now bet on the other side at $3.40 a certain amount of your money to cover up. So then you've got, no matter who wins the match, you'll make a profit. Does that make sense?
It does, yeah. So just backtracking a little bit, do you still have the option to play or to bet on a in-play game and as well as bet for like a binary outcome?
Yes, you do. And what we do, we'll have an opening position, which will be pre-match. So typically what will happen is matches on the weekend, for instance, the soccer in England, those markets will have already come up. So the market's there now, and you can have a bet. And what tends to happen is the early markets are somewhat inefficient, but as you get towards kickoff, that's when all the money comes in and the markets sort of even themselves out a little bit. So if we look at a game today and we think that the market's wrong, we'll take a position today. But then once that match starts on the Saturday night, 48 hours time, we will monitor that position and we will trade that position depending on how the match goes. So if our side that we think we've taken the initial position on goes way in front, we will then back the other side to close out a profit and hedge our position. If it's the other way round, we will then hedge out so we mitigate our loss. So it's no longer you win or you lose outcome. It's now you can win or you can win or you don't lose as much. So for instance, a bad trade for us now would typically be a 20 or a 30% loss of our initial investment, whereas previously it would have been 100%. So in that instance, what's happened? We've made a bet on a side. They've gone behind. They've gone further behind. Okay, what do? We need to start hedging our position by either backing the opposition or betting into other markets so we mitigate our loss.
Well, we're going to get into this much deeper, but before we go too much further, do you want to fill us in on your background prior to founding the Priomha Group?
Okay, well, I'm Irish by background. Okay, so one of the golden rules of being an Irishman is that you love to have a bet. So I was brought up in an environment where having a bet was the typical Saturday morning was spent with my dad and my brothers over the kitchen table looking at the form guide. So I'd been exposed to the joys of punting from a very young age. Now, through school and university, I used to have a bet and what have you. And then at the end of my university degree, which was a degree in chemical engineering, I chose to pursue a professional sporting career. I was a cricketer, and so I went over to England to play county cricket for Sussex. Now, my benefactor, the guy that sponsored me, who got me the club side and provided me with the house and the car and all the things that go with it, he was a bookmaker, and he had 2 shops in Surrey, in the south of London there. And I was playing cricket by day, and then with the long nights, I'd go work in one of his shops and be a bookmaker at night. So that was my first entree, I guess, into the professional side of sports betting, for want of a better term. Well, horse race betting and sports betting, because back then sports betting wasn't so big in Australia, but it was certainly big in England. So fast forward 4 years, when I'd realised I was not going to cut the mustard as a cricketer, I then went and worked in investment banking, finance, venture capital type industries, where I was analysing, I was looking for value, trying to find a share. If we valued a share at $2, but it was trading in the market at $1, then that's a buy. And I thought, okay, that makes sense. That's interesting. But one of the things that was the downside of that is it's very slow moving. You don't tend to buy a share at $1 and then an hour later it's $3. It might be 6 months later or a year later. So then in 2006, I was very fortunate to earn a scholarship to complete my MBA studies at Columbia University in New York. And that was 2007 was when I went. And then obviously in 2008, there was the financial crisis. So your typical Columbia MBA graduate would pursue a career in consulting or with one of the major banks, being a trader or investment banker, one of those areas. But all those jobs had dried up. And having already worked in those industries, I didn't want to go in as a 32-year-old, 33-year-old lackey. So what I decided to do was I thought, where would I want my money during the financial crisis? I thought, well, I want to have my own personal money somewhere which is liquid, somewhere which is non-correlated, and somewhere where I really knew what was going on. Obviously, the global financial crisis was catalyzed by ratings agencies manufacturing ratings of the mortgage-backed securities and a lot of other nefarious type activities. So I said, well, I know sport. Betfair, I understand that it's growing. There's a Betfair global exchange. So how about I apply those principles that I've been educated and then previously I professionally used in the realm of sports betting or trading or investing, depending on how you want to term it. So in 2008, 2009, I started with my own money and I started building my own very antiquated algorithms and fairly much focused on a little bit of horse racing, but predominantly cricket and football or soccer. And then in 2010, I decided, well, I've done this now for a couple of years. I've got decent returns. I started speaking to some friends about it, and they said, yeah, we'd give you some money. In 2010, Priomha Capital was formed as a sports hedge fund, and that's the origin of where we started, how we started, and since then, your typical client for us now has gone from being a friend who would give me $10,000 or $20,000 to now people who we have never met giving us a couple of $100,000, $300,000, $400,000, $500,000 to manage. So that is the origin of how we started and where we've got to today.
Okay, so you started the fund in 2010, yeah?
Officially, yes. That's when it was registered as a business. I was trading my own money and figuring out the strategies in 2008, 2009, but I started taking external investors' money in 2010.
Okay. And, you mentioned earlier that you'd been kind of placing bets all throughout your, even your childhood and then throughout your schooling days and that sort of thing. During that time, were you just having a punt or were you actually being somewhat strategic about your betting? Okay,
it started as a punt, but then it morphed very quickly into a strategic way of betting or trading. And effectively, I was from the periods of about the age of 26 when I finished my cricketing career or basically gave up the dream of playing professionally. For the next 4 years, my goal was to pay my rent every month with winnings from betting on sport. So that's when it became quite strategic.
Okay. And were you able to achieve that goal?
I was, yes. And that was, that was what sort of lit the fire underneath me for when, because after that was when I went over to university in America and I pretty much paid for my university degree. The scholarship paid for the tuition and the accommodation, but certainly the running costs of living in New York had to be paid somehow. And I pretty much paid them via gambling or betting or investing on sport, depending on how you look at it. Yeah, so that was what gave me the confidence to say, okay, this can be done. If you approach it in a methodical manner. One of the tricks, and certainly when I interview people for any positions within our firm, one of the disciplines that is definitely required is with sport, there's always another race, there's always another match. It's coming at you thick and fast. So you need to really be able to outline a strategy and then cherry pick your matches or your races to play in, because you can quite easily get yourself dug into a hole because there is just so much coming at you.
Yeah, so starting the fund, were there any regulation issues, any hoops that you had to jump through to do this? Because, I mean, I think sports betting hedge funds are pretty few and far between. Did you have to do any, was there any additional challenges than what there is to normally managing money?
Well, yes, there is, and that takes us to where we are now in terms of our offshore office in Gibraltar. But certainly starting off, the Australian fund operates as a small-scale private fund, which is limited to the number of investors, and that is one of the ASIC rules. So you're limited to the number of investors, retail, I guess, who invest less than $500,000. So that limits you. So as long as you stay below that threshold, you can operate as a private small fund, which is what we've been doing. But clearly, that's how we started, and it was obviously the lowest risk, lowest cost way. But given the success that we've had, we've just now registered a Gibraltar fund and a Gibraltar company, and that is a fully regulated vehicle under the AIFMD, which is the Alternative Investment Funds Management Directive, I think, in Europe. So The restraints you have in Australia are very much around the number of investors you have, as well as the number of funds you have, whereas now we've been able to parlay our success into a European fund which allows effectively unlimited growth.
Right, okay. Sure. Now, I think you may have already answered this to some extent, but, just so we're very clear on this, why did you decide to open a sports betting hedge fund rather than a fund that trades financial markets? Like you brought up previously that you had some experience in financial markets also.
Well, the real catalyst was the global financial crisis in 2007, 2008 there, where basically it didn't matter whether you owned luxury cars, property, stocks, bonds, shares. They all were fairly much adversely affected by the global financial crisis. So the dream for a lot of investors, be it professional investors managing money or people who are investing money, is to find an uncorrelated asset class, one which is fairly much immune to every other asset class. And that was what drew me to sport, because during that financial crisis, all the major sporting events kept being played. There was millions and millions of dollars being traded or bet on those sporting contests. So to me, that was the ultimate uncorrelated asset class. Couple that with the fact that having spent countless hours looking through information memorandums and annual reports and spreadsheets on financial markets and businesses, I was never going to be the best at that. I was competing against, always competing against a lot of very smart people who love that sort of thing, and not loving it was always going to be my problem. I'd done the periods of 16-hour days, 17-hour days, and quite frankly, I was not very good at it. I lacked the passion and I lacked the motivation to do it. So I guess combining the fact that I'd identified a non-correlated asset class, and it was also in an area which I actually loved and an area where I could spend 16 hours a day doing it and not feeling like it was work, that was why the sports hedge fund started. And the other thing about it was that I liked the fact that I could be sort of pioneering something which no one had ever done. I've got an obstinate part of me which was, proving people wrong and things like that. And along the way, we've had lots of criticism, and I've had lots of personal criticism about what I've been doing, but that sort of spurs me on more than anything. So rather than being lost in a corporate and being well paid to be unhappy in a corporate, I thought, well, let's start something new and let's be happy, probably earning less, but building something. And that's sort of where it all started. And look, it's now an international business with international investors, and it's sort of getting close to being where I would have been anyway, had I been working with a firm, but I'm doing it on my own back, and that's quite rewarding.
No, I love that answer. And I just want to pick up on your point about sports betting being uncorrelated to financial markets. This might be a bit of a stretch, but is there any flow-on effect? Because I would presume that if we had another event like 2008, the GFC, there would be people would have less disposable income. They'd be less likely to put some money on a sports race. Would that have any effect on you and what you're doing?
Yes, potentially, but ultimately I think betting on sport, cheering on your sports team, it's a little bit like people who smoke or have a drink, in that it doesn't really matter what's happening in the world. If you haven't got enough money, you'll still go find a beer or you'll still go buy a packet of smokes, because that's what you do, and it's part of your makeup. So I would suggest no in the overall scheme of things. What we've seen is that there has not been there hasn't been a lot of downturn. The business of sports betting has grown between 3, 5, 7% in some markets consistently over the last 10 or 15 years, and there hasn't been a downturn based on global economics, because people still like having a bet and people still will follow their sporting team. And maybe the contrary might be true, in that when life's really bad, you actually try and make more money, and you try and have a bit of a drink, and you try and cheer on your sports team even more when things aren't looking good. So I hear your point, and there might be some negative impact, but certainly we haven't seen it, and we're not big enough for it to have made an impact on us, certainly.
Yeah, okay. And just on a side note there, do you ever have trouble betting on a team that you would normally cheer for, like betting against a team that you would normally cheer for?
There is that pops up every now and then, but some people call it a personality flaw. I think it's a personality strength, is that I'm pretty good at compartmentalizing my love of anything with the pragmatism that I'm required. So ultimately, no. I'm driven by the numbers and the opportunity more than anything else. I'm not the sort of fan who will be seen wearing a replica T-shirt or wearing a scarf or something like that. So I'm not too heavily invested emotionally in any team, despite having my favourites, of course.
Okay. So you brought up earlier the fact that you did cop quite a bit of criticism for doing what you're doing, starting one of the very first sports betting hedge funds. Was it difficult for you to get investors, to buy into what you were doing? Because there is this kind of negative connotation around sports betting with most people anyway. I think most people who actually listen to this podcast will understand that there's a way that you can go about it in somewhat of a professional manner. But was it difficult to get investors to buy into what you were doing?
Well, certainly part of the problem with the short answer is yes. Early on, when I've got friends who are getting involved, they knew me, they trusted me. Some of the early investors that we took on board, we had to capital guarantee their investment, basically saying, look, you're not going to lose your money, etc. At worst, you'll get your money back. The hardest thing, and this is why the European adventure is of great appeal to us, was the educating of potential investors with respect to sport is no longer a binary outcome. You can be a punter or a bettor, you can be a bookmaker, or you can be a combination of both. So in Australia, whilst Betfair's a burgeoning business and Matchbook, etc., betting in play, being able to trade, being able to hedge, most people don't understand that as a way of trading or betting on sport. And typically most of our investors are not not 18 to 25-year-old guys or girls who have grown up with that environment. They tend to be the people who have accumulated a deal of wealth, so they're a little bit older. So they're used to just going to the TAB or going to a bookmaker, having a bet and either winning or losing. So the hardest thing has been the educating. And then the second thing which we've really focused on has been the reduction in the volatility of our returns. Because a lot of people, you hear stories about, you won $100 and you lost $100, you won $80, you lost $80. We've taken all the volatility out of our trading. So a bad month for us will be a minus 1% month. A good month will be a plus 4% month type thing. Used to be a lot higher and lower respectively, but now we've taken the volatility out of it. So people now see that it can be done. And that's been, so the hardest thing at the start was educating, as well as trying to talk to people and alleviate any concerns they had about the potential risk profile of the returns.
Okay. Yeah, that's an interesting point you bring up. And I've spoken to a few fund managers on this podcast, and that educating their investors is something that has come up a couple times as being a big part of the challenge in managing other people's money. So let's talk about this a little more, especially because you were offering a capital guarantee in those early days. That's a pretty big commitment from your side. How were you able to manage risk, and how are you able to manage risk, and how do you control the volatility of your returns? Like, what sort of things do you do?
Right. Well, the first thing is we cherry pick the trades that we make. So let's talk Premier League football. There's 10 matches every round. There's win, draw, loss markets. There's over, under markets. There are a multitude of different markets that we have information on and we can trade on. But we only ever trade where we've got a clear premium compared to the market. So that, by definition, narrows down a lot of your opportunities. So on a typical EPL weekend, we might only have 3 or 4 trades out of 10 matches and maybe 50 or 60 markets. So that's the first thing we do, is we only ever make a trade where there's value. The second thing we do in terms of the volatility side of things is that, as I mentioned earlier about the in-play trading and what that allows in terms of capability, we would rarely run an event to expiry without trading out. So pretty much about 95 to 97% of all of our trades are hedged. So what that means, a good example would be, as I touched on earlier, if you've got a football team and it's in a 3-way contest and they start at $2 and they score and they go to $1.30 or $1.40, we will then take opposing positions in that match so that we've just locked in a profit straight away and then we move on. The only instance where we wouldn't do that would be if they scored 2 or 3 goals very quickly and they were well in front, and then whilst we wouldn't trade out, we'd still monitor that match so that if the other side started coming back or the statistics said they'd be coming back, we'd start hedging out. But we're very selective and we cherry pick the trades we make, and every trade we make, plus or minus 1 or 2%, we always look to exit. So a typical trade for us will be a 15-minute or a 20-minute trade. We don't trade to expiry. We're never sitting there in the 90th minute of a football match hoping for a goal or hoping for a penalty or something like that, because we're long gone by then.
Okay, so just so I understand that right, in most cases, you're out of the trade or the bet before expiry.
Correct.
Is that because you just want to lock in your profit as soon as possible and move on, or is there a little bit more to it than that?
Well, it's a combination. There's certainly the psychological aspect of it, which is to take your profit and run. The other one is the data that we've built up through the algorithms and the statistical database. To give you an example of, in football, if a side scores and they go to $1.40 immediately, they're going to hover around $1.40 for the next 25, 30 minutes, depending on how the event's unfolding. So effectively, you've got risk sitting there, and you've got 30 minutes of risk with very little reward, because the market's not going in your favour. It will just keep ticking around the same spot. So it's a combination of the psychological love, I guess, of taking your profit and running, but also of the risk return of staying in a position longer than you need to. And that's probably the main drivers.
And while we're talking about risk here, besides taking a loss on a bet, are there any other risks inherent to sports betting, maybe along the lines of like a bookmaker going out of business, government regulations, injury of a player? Any other risks like that?
There are. I would say that all of our service providers, which are all very large, regulated betting exchanges or bookmakers, so we're not dealing with small guys. We're dealing with people who we've got agreements in place, who will accept our bets, will accept our volume, and they're registered, regulated. They're highly scrutinised because they're generally listed. Most of them are listed bookmakers. So counterparty risk it's never non-existent, but I suspect it's fairly low. Government regulations, well, that's obviously a pain in the backside in Australia, because of the fact that they don't allow in-play betting. They only allow it via phone. Whereas if you're in Europe, you can be betting on your computer and just betting in play without having to be on the phone. So those sorts of things, like we've got around that by having the office in Europe, so we can execute our trades much more quickly. Now, injury to player, that's one of the things that we like about sports is that we find that it's much more transparent in terms of the information dissemination than certainly some other markets. So a lot of you only have to pick up the sporting pages, and it's all over the pages whether there's a injury or whether there's injury clouds about people. So a lot of that information is out there. So most times we'll have taken that into account in terms of our pre-match trading analysis and pricing. Now, if one of those events happens in play, what we tend to find is that the market reaction to a player being injured is over-exaggerated. To give you an idea of basketball, we don't touch, but basketball, for instance, your main player is going to be touching the ball almost every play, so that can make a big impact. But if you look at football, as in soccer, for instance, losing a star player in the big sides, they're generally replaced by another star player, so the incremental degradation in performance expectation is not as great as one would imagine. So yes, injured players injured, they can affect things, but it certainly doesn't lead to a catastrophic loss. So if someone gets injured, the market doesn't turn completely on its head. So if you do get worried, you could then close that trade if you want. But what we've tended to find is that injuries to players tend to represent a market opportunity because the market overreacts.
And are there any other risks which I may not have mentioned there? Anything that comes to mind?
Well, there's always the risk that we could lose all the money. Like that goes with any investment fund. But in terms of external risks, not really. There's the major ones. I think are the counterparty risks, which we don't think are very, very large. We've touched on the business and regulatory risks. If you're an investor in one of certainly our Australian fund, there'd be the exchange rate risk because of the fact that the Australian fund is domiciled in Aussie dollar, the European fund is domiciled in British pound. So there's those exchange rate risks, but certainly there's no market shock. And that's one of the things that when we talk about one of the differences between our asset class and the traditional asset classes, it's immune to market shocks. And if you look at what's happened over the last couple of years with the Brexit, the way the market reacted to that, the financial markets reacted to that. If you look at when there was the Greek default with the IMF, the market reacted to that. When the Swiss franc was depegged against the euro, there was a lot of market shocks there, and there was a lot of businesses which were highly leveraged which went under because of that shock and that no one anticipating that event. So in that sense, there are no external risks which can violently upset the apple cart.
Okay. No, that's an awesome answer. Now, how important is an understanding of the sport compared to just weighing up the probabilities and payout odds? I mean, maybe if we can just get into the strategy a little more. So, yeah, tell us a bit about that.
Well, it's essential when it comes to our algorithm development. Now, what we've been very prudent with doing, and this has come as a false start from a previous bad experience, is that grabbing a smart mathematician or a smart statistician is not enough. You need to grab one who has domain knowledge of the sport itself so that they can model and they can incorporate the nuances that pertain to each sport. Subsequently, at this point in time, that's why we tend to focus on only the 3 or 4 sports, because we've only been able to identify 3 or 4 PhD quant guys who have got an innate understanding of each sport. Now, from the trading perspective, the numbers, I would dare say that you don't have to know the sport to trade the numbers per se, but it helps. Obviously, one of the big things in any sport is momentum and momentum shifts, and if you're going to be trading a sport, you need to be able to understand and notice them and see them. So that helps a lot. But certainly it's an absolute prerequisite for our algorithm development that the analyst or the developer in charge of each sport understands the sport innately.
Okay. You said there that you focus on, I think it was 3 or 4 sports. Do you deliberately avoid other sports for any reason? Maybe you feel as though there's no edge in actually competing on those sports, or is it purely just because a staffing limitation?
Well, it's a combination of a lot of things. For instance, AFL here in Australia, we won't have a bet on AFL because you can't trade. The numbers don't let you. As I mentioned earlier, a good game in AFL might have $500,000 traded on it. You compare that to $10 or $15 million traded on a Premier League match, or $50 to $100 million traded on a big bash cricket match. So there's the liquidity aspect of betting on a sport, because that's all very well getting set, but if the game goes the wrong way, you can't hedge your position. So there's the liquidity aspect. There's the innate understanding aspect, which is driven by a lack of quants. Like American sports, we would love to get involved in, but we're yet to find any analyst quant who understands the sport to the level we need. We can watch a sport. If a quarterback gets injured, we know that affects the game, but how much does it affect the game? We can't quantify, whereas certainly with the other sports, we can, because a lot of our modelling is underpinned by player ratings, we know what a player means to a team, whereas we don't in a lot of the sports. All the sports we don't trade. So it's born out of liquidity, and it's born out of the right manpower. We get a lot of CVs from people who are NFL experts or whatever that's how they call themselves, but none of them tend to stack up when we ask the questions that we ask.
So why is that? They don't have the right qualifications, or they don't understand the sport deep enough?
Yeah, well, there's a couple of things. Partly is that what we've done here is we've separated the analysis and the trading side of things. So our analysts don't trade, and our traders don't. They help with the analysis, but they certainly don't build the algorithms. They'll help with some input. So we've separated those two functions within the business. So a lot of the people that come to us, they're gamblers. They don't. And this is the other thing about American sport, is that because America has been effectively a binary sports betting nation since eternity, you either win or you lose, they don't actually have the concept of trading. So a lot of the American people, or a lot of the people who tell us that they're specialists at America, they will be having binary bets, win and lose, and that brings with it long good runs and very long bad runs, which then takes our volatility up. So that's why we don't tend to find we haven't found anyone good that matches us as yet.
Okay. So here you're talking about PhD quants, you're talking about statisticians. How much discretion do you use versus quantitative methods in regard to your bets?
Okay. Well, first, certainly there's the typical work week, for instance, is, say we've got a weekend round of sport coming up, we'll have all the data and we'll have our prices by Tuesday or Wednesday morning. And then there's a discussion amongst the team about, all right, what's happening? You know, there's a big match this weekend, for instance, Liverpool versus Everton in the football. That's a Merseyside derby. Stay clear of that, because there are so many qualitative factors in a Merseyside derby that's impossible to bet on. You know, these two sides hate each other. They've hated each other for hundreds of years, etc. So that aspect comes into in the previews during the week of what's been happening. Are there any external factors we need to take into account? How will that affect our price? And most of the time when there's an external factor like that, even if there's perceived value in the market based on our output, we'll steer clear of that event purely because of the unknowns of those qualitative factors. Now, once a match is in play, that's where the trading becomes, I guess, 80% algorithmically driven and 20% trader-driven, market-driven. So there's probably a 20-80 split of the trading once the match goes in play.
Okay, so would you describe the way that you guys bet on sports as a strategy? Is that the right sort of way to frame it?
Yeah, absolutely. we have a couple of strategies which we like, market strategies where we bet in a certain way on a certain market, and we just replicate that all the time. That's sort of our bread and butter trade. So that's definitely a strategy, and the way we approach it is a strategy as well. For us to get involved, we need at least a 25% premium on. So if we've priced something at $2, we need to get in $2.50 in the market for us to be interested, sort of thing. So yeah, it's all underpinned by a robust strategy which has been developed by trial and error back when I was playing with my own money, but has since been continuing to be optimized since the start of the fund.
And do you guys do any work on actually validating those strategies before you start actually trading them?
Yeah, absolutely. So the typical process of building an algorithm or building a sports data set, there's a certain element of that which will be trialing the trading strategies which I want to employ, or we want to employ, because it's instead of, I guess, the process is, all right, there's an opportunity in the golf market, in this type of market, it might be betting on the first round leader, or it might be betting against the first round leader. We have a strategy, a hypothetical strategy, and then once we built the database, we then back test that strategy against all previous results, and then that gives us an idea of where we should be headed and what we can expect. So yeah, it's all driven by that. Yep.
Okay. And is it fairly easy to come by data for sports betting?
Very easy. Well, the data is a commodity. The data itself is, if you wanted to build your own model on football or EPL or something, the historical data is very easy to come by. So, and if you want to get live data as it happens, you can purchase that, have that streamed straight into your own system. So that's very easy. The data itself is a commodity. It's very easy to get. The trick is understanding and developing a system which recognizes data which means something and data which is purely noise. And there's a lot of noise. And in terms of possession, if you look at possession, historically possession used to be in football, soccer, it used to be a good determinant on who would win. Leicester managed to win the championship last year, generally with 40% or less possession. So that's noise, and that's the sort of stuff you need to be able to wade your way through.
Yeah. So, I mean, it's much the same as data for financial markets as well.
Correct.
How do you measure your performance as a fund? Like, how do you measure how successful, how well you're doing? Is there any way you measure this besides your bottom line?
Yeah, we measure it. A couple of things. It used to purely be just bottom line. You give $100 on January 1s, $150 on December 31st. Okay, we've had a 50% year. That used to be as simple as that. But as we've developed the business and as our investor has become more experienced, more sophisticated, there's been other metrics which we've had to incorporate into the business as a way of testing ourselves. And volatility, number of negative months, obviously comparative returns to a couple of benchmarks have all come into it. So volatility is the big one. We've tried to, because it's a new asset class, because it's an asset class which may or may not be deemed an asset class by many investors, and rightly or wrongly it might be perceived as being slightly more risky than others, we've tried to really take out the volatility of our returns. So as a result of that, that's one of the key metrics by which we now gauge our own performance is typically number of negative months. So that's probably the more, because obviously if the less negative months you have, you're going to end up getting a good return anyway. So that's been one of the big things we've been focusing on.
Okay. How do you measure the volatility of your returns? Is there any method to that?
Well, there's the mathematical methods, if you like, in terms of just your standard deviations and number of negative months, average number of negative months and things like that. And that tends to be quite rudimentary and basic in that sense. But certainly drawdowns, we talk high water marks, things like that. We know where we've been, so we know that what our high points have been, and we know we don't want to drift too far below that. So it's a combination of all those. There's no one metric which drives it. It's effectively, we know how positive we've been. We know we don't want to get below a certain negative, so then we'll make sure that if we're tracking that way halfway through a month, we'll then revisit the algorithms, we'll revisit the trading strategies, and we're doing that all the time. So it's an ongoing moving target driven by number of negative months more than anything.
Now, this question here, I'm really keen to ask you. I'm not sure what you'll think of it, but we hear stories about races being fixed and sort of shady business in the sports betting field. Do you see anything like that? Is that something that still exists to this day?
I would say yes is the answer to that. The short answer to that would be yes.
Okay. And what sort of sports do these mostly happen in?
Well, look, I think a lot of it's great news. It's a great news story when someone talks about match fixing and things like that. But I suspect what you'll find is, and this is certainly our experience, is a lot of the match fixing, a lot of the spot fixing, some of the nefarious activities. If you're looking at tennis, it's at the very lower levels of tennis where guys are scratching around for a living. The top guys in the ATP and the Grand Slams, they tend to be. It would take a lot of money for them, I would have thought, to be persuaded to ruin a legacy. Similar to the football in Europe, I noticed Luis Suarez this morning has just signed a new contract with Barcelona, and for someone to buy him out, they have to pay $250 million or something ridiculous like that. So the incentives are not there at the high levels of sport. They are there at the low levels of sport. Now, for us, the low levels don't really matter because we can't bet on those because the volumes are not big enough for us to trade anyway. So we tend to confine ourselves to the higher upper echelons at the highest level of sport where prudence and the way it's managed and run is at its highest. So yes, for sure, there's always going to be someone trying to make a quid out of it, but it tends to be in the lower levels, suburban levels, through to the futures tours on the tennis tour, which doesn't affect our business.
Okay, yeah. So it's not something you've really got to worry about too much.
No, and the other thing you need to point out there is that, as mentioned earlier, 97% of our trades don't depend on the outcome of the match. So we're immune to that as well. So we're not sitting there in the 90th minute and the goalkeeper lets one go through the legs and we've lost. We've traded for 15 minutes in the first or second half. We've made our money. We're out. The actual result doesn't matter.
Okay, got it. Yeah. All right, Brendan, well, let's do one last question and then we'll close this out. What suggestions would you have for someone who is interested in sports betting and someone who's actually serious about it, not just interested in having a punt? Anything you'd like to pass on to them? Any final words? Yeah, well, look, as much as we bet on sport, we don't really bet on sport, if you understand that. Sport just happens to be, the market is a market, and sport just happens to be the vehicle by which we that's the vehicle we use, happens to be sport, but it's the same as any other market. In terms of sports betting, the things that the three things you really need if you want to have fun out of it or you want to do what we do out of it, the first one is to understand that there's always another race or there's always another event. So you don't need to be betting every sport. You don't need to be betting every event. You want to bet on something you actually know and understand, because this is one of the reasons why I got out of the financial markets per se, was because if I'm buying a BHP share, that means someone's selling a BHP share, and if someone's selling it, they're probably going to know more than me. So I should be asking myself, why am I buying something someone smarter than me selling? So you want to be making sure that you
bet or trade a sport you understand. You want to make sure that you're not being forced or you're not pressurizing yourself to have a bet, because there's always another event. And the other thing is, if you want to make money out of it, you probably got to do it in a very boring fashion. And a typical example for us is our maximum trade is generally it's up to 3% of funds under management, but it's typically only 1 or 1.5%. So we're not having typically if you got $100, we're not having $50 on an event. We'd be having $2 or $3 on an event. So the money management side of it is very important, because you've always got another event coming up. You want to make sure you've got money to bet on that event if that event fits your criteria. So yeah, we approach it in a very boring fashion. So it's probably not going to inspire anyone to want to get involved.
No, I think that's what you got to do to make money over the long haul anyway.
Well, slow and steady. And that's how we people, and this is one of the things that when we speak to people who are interested, they tell us how they've hit these hot streaks, et cetera, and these tend to be Americans looking for jobs or people who specialize in American sports. And typically what we look at, we don't look to hit the home run, we look to get the first base, and we try and get the first base all the time. And if you do that, you've end up waking up at the end of the month and you've had a good month. The home run is nice, but the home run is also hard to find.
Yeah, and just to clarify, you mentioned in your answer there that you often risk 2 to 3% of your capital, your assets under management on a trade. But you also mentioned earlier in the interview that you often only lose 20 to 30% of that 2 or 3%. Is that correct?
Correct. That's right, yes. Not 20 to 30% of the whole fund.
No, that would be scary.
That would be scary, yeah.
All right, Brendan, well, let's leave it at that. It's been really good speaking. Thanks a million for coming on. Where can listeners go to find out more about you? Well,
Priomha, www.priomha.com. That's Priom, H for Harry, A for Australia.com. That's our website. That has all the information about both our Australian fund as well as our international fund. So if people are interested from an investment perspective, you can drop us a line. If people are interested from a work perspective, we're always recruiting. It's one of the things we try and do is recruit good people. So we're always interested in hearing from good people.
Excellent. And are you on Twitter also, Brendan?
Yes, we are at Priomha.
Okay.
And Skype, and we're everywhere. We're ubiquitous.
Excellent. Well, of course, as per usual, include all those links in the show notes at chatwithtraders.com. Brendan, again, thank you very much for coming on. I appreciate it.
Aaron, pleasure. Thank you.
You've reached the end of this episode of Chat with Traders, but rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast on iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.